Hello friends, welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Liberty. Is it worth a look at these levels or an avoid? So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position or any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Liberty, a small request is kindly support me on Patreon. Once you do that, help me grow the channel, help you also ask me questions and seek out answers in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts. And also, if you can pay $100 upfront, you get 1 year access by paying for 20% less. For detailed market or company talk or number of stocks you're holding, you can directly email me and we can work things out with a fee. And also, if you cannot pay on Patreon, you can directly email me and we can work things out with other payment system as well. Now about the company. This company was established in 1954 and it is one of the biggest retail brands here in India. Manufactures top quality footwears, and although it is second or third rung behind Bata and Relaxo, but Liberty has its own niche. Its major brands are Healers, Gliders, Force 10, etc., and has export operations to multiple countries across the globe. The market cap of the company is around 270 crores, so nothing great, and that is where the attraction is, that the sales is around 400-500 crores and market cap is half of it, so currently trading at 0.5 times sales. In terms of numbers, for Q3, nothing great. Sales were flat, just 3% growth, 151 crores. Profit dipped by around 5%. Normally, for December quarter, most of the footwear brands had a very good profitability and top line growth, but Liberty did not. That shows you that how they are losing market share, perhaps. Debt is there, but it's not huge, but there is debt. There are other companies that are debt free, high promoter holding, and operational numbers are decent, but then due to the debt and many other expenses things and depreciation, the bottom line has deteriorated. Return on equity of 4% is nothing great to write home about. Margins at 11% is not that great in a consumer business. It is okay, not bad, but not magnificent either. If you look at the performance, it has been an underperformer for many years. At 6 years lows, currently around those levels of 150, 160, has not done anything for the past year as well. Although most of the companies have recovered from lows, even from those lows of February, many of the footwear companies that are listed have recovered, but the return ratios are so average that you don't seem to find this going. Will suffer in current business scenario, as you say that interest rates are going up. You see that any debt laden company will suffer with higher interest rates, and with the RBI increasing the interest rate going forward as well. I don't think the company is going to do much better unless sales really explodes and probably goes to something like 250 300 crores a quarter. So do not seem like recovering at the moment in the kind of mires that the company is. So why I believe is an avoid. This is not a leader. In fact, this is third or fourth on the list. In fact, something like a Mirza International is doing much better. Difficult times may lead to lower market share as we go ahead. I think pressure on margins, pressure on expenses, pressure on cost would be there, and so they would have to spend on advertising, etc. But other companies are taking market share. Again, there will be a lot of pressure on the numbers, especially on the bottom line. Shutdown is another deterrent for the company, and financial performance is nothing special for the last 10 12 quarters, 15 quarters. So what one needs to do is especially look at a scenario where the company starts performing well and only then get into the stock. There are major companies or major player that is coming at a discount. We had Bata that was coming at very low levels. It has run up from there, but around 1900 1800. Similarly, other companies like other companies in the same sector are doing much better. So it is better to be with leaders rather than be something like Liberty. In terms of stock technicals, it has broken all support levels currently at 6 year lows and need to get past 200 for any sustained up move. So currently at 150, 160, we may see a 20%, 25% rally, but then the stock may reverse as well. It has been in a continuous downtrend over the last 8 years. It's not 2, 3 years. So one has to see how performance picks up and the stock performance picks up, and only then, even on a technical basis, one should look at buying it at it. See, for risky investors, these are good levels to buy because downside perhaps is protected the way it has fallen so much. But really, if you really want to make a lot of money, then it's better to be with high growth stocks, even in the same sector or in other sector, at least something that is growing at 20-25% CAGR rather than something that is declining in terms of numbers. So, in my opinion, avoid at these levels, wait for numbers to improve first and then get into the stock. Look at market leaders in the space or in other sectors which are set to do well over the next 3-4 years. And even if you have positions in the stock, then have only 5% exposure into it. So, this was my video on Liberty. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it. And kindly support me on Patreon. Thanks a lot for watching.